Hey everyone, Michael here. So in this video, we're going to have a look at Google and see how it performs on the Simply Wall Street company report and what kind of insights we can gain from it. So the purpose of this video is basically to show you how I would research a stock using the report and then kind of what my next steps would be to learn more about the stock to see if it's worth investing in. So we'll go through the whole report and I'll share with you the insights that I'm gaining. Now, if you don't want to watch the whole video and you just want to see a quick summary of the insights that we've gained, I'll share that in just a second so you don't have to watch the whole thing. But if you do want to learn a bit more of the specifics about how to interpret the different sections of the report and what insights you can gain and like takeaways, I would suggest watching to the end of the video because I'll walk you through each part of the report and that could be very helpful. So we'll also have some chapters down the bottom so you can see which particular parts of the video cover what sections. So hopefully that'll also help if you want to skip ahead to some of those sections. So with that being said, a quick summary of basically what the insights were that we found from looking at the company report, or what I found looking at the report. Firstly, Google is a potentially undervalued and highly profitable stock, right? So according to some of the metrics that Simply Wall Street checks, the stock might be undervalued. And in terms of its profitability metrics, they're just incredible. Like it really surpasses the industry that it's in, and it's able to allocate money very profitably. Another takeaway was basically that the company has like a 92% share of the search engine market. So it's got a very dominant position, as I'm sure many of you already know, because it's probably your preferred search engine provider as well. The other thing is it also has some potential new drivers of growth. So that can be in the form of like partnerships with other companies that it has, which I'll get into in the news section, and other parts of its businesses like the cloud and AI section, and even new markets as well that it might be expanding into, and we'll cover on that in a second as well. Some of the other takeaways were that it has like an impeccable balance sheet and a really strong track record, and we can see that here as well from just looking at the Snowflake. And also it doesn't pay a dividend, so the company has chosen to reinvest all of its earnings, and that makes sense because it's allocating the money very profitably. So that's why it doesn't score well in the dividend check, because it doesn't even pay one. And lastly, in regards to the management, it's got a very aligned management team and a very experienced management team. So they've all got, like many of them have got millions of dollars invested in the stock in their own personal names, and they've also got an experienced tenure where they've been in their positions for many years, and so they've got a lot of experience in those particular roles. And lastly, in terms of like insider transactions, if there's anything to worry about, there isn't really. Like there was only a tiny transaction like 9 to 12 months ago, and I think no real big takeaway to learn from looking at insiders transactions over the past 12 months. So that's the key takeaways that we learned, or that I learned from looking at the report. And now if you'd like to learn more about each of those particular sections, I'll go through each of them now and show you how you can interpret each section as you read through the company report. So the first section that I would start with obviously is at the start of the report here, and it's the Snowflake and the risks and rewards. So the first thing I have a look at is the Snowflake, and we can see here that the company has like a really strong balance sheet in terms of its health. It has an impeccable track record where it's just like smash out of the park in terms of all 6 metrics that Simply Wall Street checks. The company has good future prospects, passing like 3 out of the 6 metrics checked, and it has pretty good, it could be potentially good value in this sense as well, because it passes 3 of the 6 metrics that Simply Wall Street assesses, and I'll get into more detail there in a second. And the company doesn't pass any checks in regards to its dividends, so that's because it doesn't pay one. So already from just looking at the Snowflake, we can see that the company has like a solid balance sheet with an outstanding track record and like good future prospects and potentially good value. So quite interesting, and we can get much more detail as we read through the report, and we'll go do that now. So first thing though, the risks and rewards, they're the next section that you look at. So I can see here by looking at this that the company, according to Simply Wall Street's estimate of fair value, it's trading at a roughly 40% discount to its estimate of fair value. Now I'll get more insight on that in a moment just by looking at the calculations and the actual numbers and inputs and assumptions that are in the model, and then I'll share with you how you can basically like take that takeaway and then like tweak it, or like have your own inputs basically to like come to your own conclusions based on your own assumptions and your own forecasts based on your own research. So I'll get to that in a second. Now the next reward I can see here is that the company's earnings are forecast to grow at like 12% per year. That's pretty good. Like not huge earnings growth, but it's solid. And lastly, I can see that the company's had a really strong year, and one of the rewards was that over the past year, its earnings have nearly doubled over the past 12 months. So it's been an outstanding year. Seems like ad revenue has been a real strong performer over the past year, as a lot of people have turned to digital advertising, and many businesses have gone online, and Google seems to have been a big beneficiary of that over the past 12 months. In regards to risks and all the risks that Simply Wall Street checks, none of them really popped up. So in that regard, it's quite encouraging to see. So the next section I would have a look at is the competitors, basically just to see if I'm looking at a stock here, is there any competitors I should be concerned about or any potential better opportunities? And now this section is really useful because it provides the Snowflake, and as we know, the Snowflake can teach you quite a lot about the underlying business. And so having a look here, I can see that there's the likes of Facebook or Meta platforms, Match Group, Twitter, and Pinterest, who might be some potential competitors for Google. And so having a look at them, I just compare the snowflakes to Google to then see, like, it kind of also depends on what you're looking for in a business. So if you're looking for like an undervalued stock, which is kind of what I'd be looking for here in Google, which is why it got my attention originally, trading at such a discount to Simply Wall Street's estimate, I would then typically want to see a snowflake that performs well in the value section. And obviously, like, I keep an eye out on the other sections, but that's the primary one that I look for. So comparing here, I would look at Facebook or Meta platforms and be like, oh, okay, it's considered pretty good value as well. Like, it passes a few of the metrics, and it actually has a very similar snowflake to Google. So a very good solid balance sheet, past track record, mediocre good future prospects, and like good value and no dividend. As for Match Group, Twitter, and Pinterest, they're very different, right? So Match Group has very good future prospects, Twitter has bit better future prospects, and then Pinterest has like a really solid balance sheet and good future prospects as well. So part of my research process would be, once I finish looking at Google, to go and check out these competitors and just see how they stack up in the same analysis, and if there's a potentially better opportunity, or if there's like something that could change my thesis on Google, as in like, oh, okay, these guys might be a significant competitor or whatever reason, or whatever sort of insight. So that's part of the research process as well, just having a look at these guys and their company reports as well. So the next section I have a look at is the price history and performance. And now, if you've watched any of my previous videos, you'll know that I don't use share price movement as an indicator of whether I should buy or sell. But what I use this section for is basically to get a more qualitative understanding of the business, and like try and help build my narrative and story around the stock to get a better understanding of it. So this section is really useful, right? Because you can go back to even 3 years' time, and like all these developments down here are developments in the underlying business. And so what I would do is I would have a look, let's just say for the last year example, and I'd try and keep an eye out of like if there was any big sudden share price moves, which like obviously it's like a catalyst, like a positive catalyst or a negative catalyst. I'd try and keep an eye out to see if there was any blatantly obvious sort of changes, and then I'd try and look for any events that happened. Like if there was a huge share price spike here, I'd try and look at the events around here and see like what happened, what was the news that came out that changed the market's sentiment around the stock. In the case of Google, there doesn't seem to be any huge transitions or huge changes in sentiment in that sense, but it has just been like a solid gradual increase over the past year, and so like regardless, I still want to look at the underlying developments, right? So one of them might be like, have a look at this strategic alliance, for example. And as I mentioned in the summary, one of them is the partnerships that they're doing. And so you can see Google here is teaming up with Shopify to help 1.7 small to medium business owners reach more consumers. And so small to medium businesses account for more than 95% of firms and 60 to 70% of employment, and they're projected to bring a large share of digital advertising revenue. So that news right there helps add context to my narrative and helps add to the story of what I'm trying to understand and the thesis I'm trying to build around this stock. And I'm like, okay, Google seems to be building out partnerships with the likes of Shopify, and if I read other developments, maybe others, to expand its reach, right? Because these small to medium businesses in this example could help increase its digital ad revenue from the likes of the small to medium businesses, which may not have originally spent that much, but now they could be, thanks to Google partnering with the likes of Shopify. So that right there may help build my thesis of ways Google can grow. And another thing I might look at is like this other one here. And now this is an example of what I was talking about of expanding into new markets, where it's like Google to invest $1 billion in Africa over 5 years. And now they just want to provide, or they're trying to, over the next 5 years, to provide access to faster and cheaper internet, and will back startups to support the content's digital transformation, it said back in October. So that kind of development right there tells me, okay, over the next 5 years, I should expect that Google's going to be investing in Africa. And if the digital transformation of this market continues, that could be like a real growth catalyst for this stock, right? Because if they do still have that, well, they have that digital advertising revenue in this space, and Africa is an emerging market, that could be a new growth driver for that stock as well. So as I read, so what I'm getting at is, as I read through these developments, it kind of helps me build my thesis and helps me understand more of the underlying business. And this section here is really useful for that. So after the video, I would go through and read through a whole bunch of other developments to try and get more of an understanding of it. So that section there is very useful for that, and you can go back as long as you like as well, like 1 year, 3 years, just to learn more about it, because sometimes developments start many years ago and they only start to contribute to the bottom line in terms of earnings profit like many years later when they're finished. So that might be the case with this Shopify example and the Africa example, where they don't contribute right now, but like it's important for us as investors to try and be forward looking and be like, okay, this is going to contribute to the bottom line in 3 years time. add that to my thesis or add that to my narrative around the stock, and then keep an eye out for it in the future, and it helps me predict where I think the earnings will be in 3, 4, 5 years time. Now, the next section here is very similar, right? So this is the recent news and updates section, and I would use it for the exact same reason. So basically reading more about the underlying business and getting updates about its underlying business, and also getting different pieces of research about the stock. So as we can see here, one of these is written by the analysts internally at Simply Wall Street, Richard, and so he was writing an article about how the stock has like really solid fundamentals and a reasonable valuation, and how like its high returns on equity are really helping the company grow its earnings because it's just able to allocate its money so profitably, or shareholders' equity so profitably. And so having that kind of gives you a more qualitative understanding of the business. And also one thing to note is that we also have a partnership with Seeking Alpha. So there's articles here that are published by authors on Seeking Alpha, and we surface them here and give you a summary. And one thing I think they're really useful for is to give you like just to give you also more research, but also potentially give you contrary opinions to what you may have already as a preconceived idea. So let's say, for example, I'm super bullish on Google and I'm like, yep, nothing can go wrong. I'm like tunnel vision on it's the perfect stock ever. Then I go through and read through some of these research reports, and I find someone else has done their own research and they've covered things that maybe I've missed and things that I haven't considered. And it's like, that's really useful, right? Because it helps give you it helps you build a more informed base and knowledge base to then make an informed decision and an empowered decision where you've actually considered everything. So if I like look at why they have they've looked at a few certain aspects of the business and they're like not as bullish, and they list out reasons X, Y, and Z as like why it won't be as higher growth or whatever, I then look at that and I go, oh yeah, geez, I didn't consider those aspects. Maybe they are right. And then like I have that information now, and I can make a more informed decision on my forecast. So it's really useful to like try and avoid confirmation bias. Like if I'm bullish on a stock, just finding everything that says, yeah, this stock's great, this stock's great. It's really useful to try and find people who think the opposite to you. As Charlie Munger always says, invert, because it's like so important to find out like where the stock could go wrong, or what am I missing? Why am I wrong? Because by looking at that and trying to prove yourself wrong, it can really help you make better investing decisions where you're not just investing on emotion, you're investing on reason and logic, based on like well-founded and informed research. So that's what these sections are really useful for. And also just all of the updates that occur with the business, they can also just help give you like tangible evidence of like what's happening. So that's what this section's for, and it's really useful in that respect. And just one last thing is reading these articles and research and stuff is what helped me gain that knowledge on like Google's new growth aspects through the AI business and the cloud business, and like the dominance in the search engine space of like 92% and stuff like that. So that also helps obviously build the narrative and the thesis around the stock. So very useful to read these kind of sections. Now, the next section I have a look at here is just shareholder returns, and I just typically want to compare it to how it's gone, how the industry has gone that it operates in, and how the market has gone compared to the stock. And so we can see here that Google has gained like 68% over the past year, which is incredible, and the US interactive media and services business industry has gained like 39% over the past year. So also an incredible year, but Google even surpassed that. And not to turn your nose up or anything at it, but the US market gained 21%. Now that's still a solid year, but it just goes to show that like the US interactive media and services industry and Google performed even better. So very high quality business in that sense. Like the market has had a great year overall, but this business and industry has done even better. So it tells me that it's like performed really well over the past 12 months. And one thing I want to keep in mind as I research is like, is it likely to continue? So I can get more insights on that in the future growth section. And now the next section I would have a look at, if it was a business that I wasn't too familiar with, is this about the company section. So just learning about how many employees it has, who the CEO is and stuff like that, and learning about what the company does and all the business operations it has. In this particular company, it's actually a pretty short section, but it can get very long and in more detailed businesses that are a bit more complicated. But this is just useful to basically catch up to speed to make sure it's like a business that you understand that you're looking at. Because if it's a business you can't understand, and like I have no idea what they're selling or what they develop or how the industry works, it could be a sign that you need to like do more research on the business and the industry itself and how it actually works before you start doing like stock research. So in this case, I won't read it because I'm relatively familiar with it, but that's just what that section is useful for. Now, the next section that I have a look at is the fundamental summary. And basically, this is really good. It gives me a few key metrics, both here and in the next section, about how the underlying business is performing. And I've done a bit of research that will provide some context to this graph down here, and I'll go through that in just a sec. So the first section I look at is the market cap, and I can see here that it's 1.93 trillion. The company generates revenues of about 239 billion and earnings subsequently to that of $70 billion. So pardon me, those three metrics, those three numbers there give it these ratios over here. So those earnings of 70 billion and a market cap of 1.93 trillion give it a price to earnings ratio of 27 times, and the revenue of 239 billion gives it a price to sales ratio of 8 times. Now I may look at 27 and be like, oh, that's pretty good value, but one thing to keep in mind is that a P ratio needs additional context, right? So I need to know, and in terms of additional context, I mean like, what is the expected earnings growth rate of this company? Because otherwise, without that piece of information, I have no idea if 27 is like a high valuation or a low valuation or fair, because I don't have any underlying understanding of like what the expectations are for the business's earnings growth. So we'll get to that in the future growth section, but just to keep in mind, like if you look at a P ratio by itself, it's not as useful, and so to get more use out of it, it's very important to have a look at the future growth section so you can then get some context around it. As for the price to sales ratio, this company is profitable, so it's not too meaningful to me, because I can refer to the price to earnings ratio, but a price to sales ratio of 8 times is pretty standard, I believe, and I would have a look at this if it was an unprofitable business, but in this case it's not, so it's not too meaningful to me. Now the next section is the earnings and revenue breakdown, basically more detail on like how the company's income statement kind of looks. So here I can see that the company generates that revenue of 239 billion as we saw, and in order to generate that revenue, which is the likes of like the ad search revenue, the cloud services revenue, the AI business, or like sort of some data, those are new more like other bets that they have, but the hardware businesses as well, where they sell like the Pixel phones for example, generates revenue of $239 billion. Now the cost of generating that revenue is made up of what inputs they need to spend to generate those things. So for example, for the search engine business, they have something called traffic acquisition costs. And this article here is a good example where it's like much of the costs that Google pays is to companies like Apple to be the default search engine on their iPhones and other devices, and that's the stuff that's called traffic acquisition costs. That makes up the majority of their cost of revenue, because the ad search revenue, as we know, is like the majority of their business, and the remainder of the cost of revenue is the likes of actually building the hardware for the Pixel, like actually creating that sort of device. That's a part of their cost of revenue. And also in regards to the cloud business they have, part of that cost of revenue would be like the paying for the data centers, right? Because they have to pay for the data centers to provide the cloud service, and so that's part of that cost of revenue. So with that context, we're like, okay, to earn that much, they had to spend that much, and that leaves them with $135 billion in gross profit, right? Gross means just before we consider expenses. So these expenses here are the likes of general and admin, sales and marketing, research and development, those kind of things. So it's like employee wages, their research and development costs, how much they're spending on their marketing budget, and all those kind of things. And so they've spent $64 billion over the past 12 months on those kind of things. And after all that, that leaves them with $70 billion in earnings. And so with that breakdown of like the waterfall of how that works, that gives them like a gross margin of 56%, right? Which that's the gross margin here, 135 divided by 239, and then the net profit margin is 29%. So that's a very solid business, right? 56% is a good gross margin, and 29% is a very good net profit margin. So very interesting takeaway there, and that's a good understanding of, or looking at this is like a good understanding of how the business makes and spends money. And the last thing takeaway here is like the debt to equity ratio, and looks like Google doesn't use much leverage at all, so it's got a debt to equity ratio of 5.3%, so very low, and that probably helps explain why it has such a good health score, but we'll get into that in just a second. So the next thing I look at is the valuation section, and having a look here, the company passes 3 of the 6 metrics that Simply Wall Street checks, and we'll start with the first few. So according to Simply Wall Street's estimate of fair value, the company is trading at a discount of like 40% to its fair value. Now that's pretty solid, and that's really appealing. Now, one thing I want to stress is that this section right here is not a buy or sell recommendation at all. It's more an indication of like a fair value of what could be generated as a fair value if you use some particular inputs. And so if you want to know what those inputs are, it's very useful to go to this section here and see what inputs actually were put into the model to get that estimate. And so you can see the discount rate, perpetual growth rate, all these different other factors, and then the levered free cash flow, which is provided by the analysts that forecast it, and then Simply Wall Street's extrapolation of those growth rates at a particular line. So this gives you a breakdown of how we actually got to that number. And now one thing I want to stress here is that like if you're an investor and like you have the sort of understanding of like how to do these kind of discounted cash flows. One very important thing is to know that if you change these assumptions and inputs and particular numbers here, which is what they are, it can have a big impact on the estimate of fair value that you get, right? So let's say, for example, you believe that the perpetual growth rate of Google after year 10, because that's where this is from, like year 10 onwards, you think it should be more than 2%, right? Like you think Google's just going to dominate from year 10 to 20, and it should be much higher than that. Let's say you say it's 3%. If you were to change that to 3%, that would have a very big impact on the company's fair value, right? Like it would increase it quite a lot because you're saying the company's growing faster into perpetuity than this model expects. Alternatively, let's say you said 1%. That would reduce the fair value, right? Same thing here for the discount rate. Let's just say you think that the cost of equity shouldn't be as high, or for whatever reason, you think it actually should be lower. If you were to use a lower discount rate, as in the rate that you discount the future cash flows at, that would increase the value of those future cash flows, right? Because they're not discounted at as higher interest rate. But if you were to say, no, I think the discount rate should be 10% per year because of X, Y, Z, whatever, then that basically indicates that those future cash flows would be smaller in today's present value. So that would have a big negative impact on on your estimate of fair value. So just a bit of context there, but this kind of thing, for example, you can go and create an Excel spreadsheet. There's plenty of free cash flow guides online and like blank templates. You can go in and like pop these numbers in to see how we got the model, or the fair value, I should say, from the model, and then you could adjust them, but you should adjust them based on your assumptions. So you need to have reasoning to adjust these numbers, right? You wouldn't want to just adjust them for the sake of it and be like, oh yeah, this gets me a number that I want. It's like you'd want to have an input as to why you're adjusting it and why you think the perpetual growth rate should be higher, or why you think the discount rate should be less, and stuff like that. And even with the free cash flow estimates as well, you may think, oh, I think Google's going to be earning $85 billion in free cash flow in 2022, and higher numbers further on. You need to have a reason for that. You may think, oh, the cloud business is going to be huge. The Pixel is going to become the biggest selling phone in the world, whatever. Those kind of inputs, those kind of assumptions are needed to change the inputs, right? So just keep that in mind if you were to go and try and do your own fair value estimate. So according to this model here, from Simply Wall Street, it believes that it could be trading at a discount to this potential estimate of fair value, which is interesting to know. Now, just in regards to its industry and market, this right here just gives us a comparison of the PE ratio. So it seems to be trading roughly in line with the industry that's in, around 27 times earnings, but Google actually seems to be a bit more expensive than the market that it's in, trading at 27 times versus 17 times for the market. So like I said, looking at a PE ratio by itself doesn't provide much context. I need to also look at the expected earnings growth rate of those particular sectors and companies. So we'll get to that in the future growth section, and it'll provide me some context to these numbers, and then I can make a more informed decision about whether it's like a reasonable valuation or not. So price to earnings growth ratio, not too meaningful to me here. Price to book ratio, not too meaningful to me here. So that brings us to the future growth section. Now, I use this section obviously just to get an idea on what the estimates are for the company's future, right? And so Google passes 3 of the 6 metrics that Simply Wall Street checks, and we'll have a look at them now. So according to the 39 analysts that cover Google, they reckon it's going to have an annual earnings growth rate of about 12% per year for the next couple of years. That's pretty good. That's pretty strong. And so you can get a visual representation of that here on the graph, and I can see how the company's performed in the past. And according to analysts, it seems like it's going to be like a continuation of the trend, right? Like this is the forecasted earnings and revenue, and it seems to be more of the same. So what I can tell here is that it's like, or what my takeaway is that it's like, okay, there's no significant like change or like catalyst that's expected to change the company's fundamentals significantly, right? Like it's expected to have just more of the same sort of growth going into the future. And like it does seem like earnings growth is actually flattening out a bit more than revenue. And so that might tell me, okay, like its margins are going to compress for whatever reason. And one thing I looked into was that traffic acquisition costs. As more traffic is actually driven to mobile rather than desktop, mobile traffic acquisition costs are actually a bit higher than desktop acquisition costs. So that insight right there might tell me, oh, okay, because they have to pay more for the mobile traffic acquisition cost, maybe that's compressing its margins a bit. So you can see here like profit and such isn't rising as much as revenue. So that's one potential thing to keep in mind there. Now, the next section I look at is the analyst future growth forecast. And this is exactly what I was talking about providing context to the PE ratio that we were looking at above. So here we can see, like we saw, the company was trading at a PE ratio of 27, the industry was about 27, and the market was about 17. So with that in mind, you would expect that the market would have a lower earnings growth rate than the industry and company, right? As it turns out, it's actually higher than the company. So even though it's trading at a PE multiple of like 17, the earnings for the company, are actually lower than that, lower than the market, I should say. And so that's interesting, right? Because people are willing to pay a premium for Google. So that could be for any number of reasons, right? Like maybe just this because Google is such a well-known brand, such a dominant player in the space, has like a big monopoly over the search engine space and ad revenue space. Maybe that's why people are willing to pay a premium, even though it doesn't have as high earnings growth. So that could be one thing to keep in mind. But as for the industry, it's like, okay, if I was to think about the space that Google operates in, if I wanted to look for like higher earnings growth opportunities, there may actually be better opportunities in the industry, right? If I was to go to the screener and I look at the interactive media space, and then I filter by earnings growth, I should keep an eye out for companies that have like better earnings growth expectations than Google, just because that's what this chart here is telling me. Because it's like they're both trading at roughly 27 times earnings on average, but the industry is actually expected to have higher growth. So there may be better opportunities out there. If I wanted to look for them, I would go to the screener and check them out. So that's just, these numbers here have provided context to, okay, like why is Google trading higher? Well, maybe it's a premium brand, like I mentioned. Is Google the best opportunity? Maybe not. Maybe I should go and look at the interactive media space and see if there's better earnings growth opportunities out there. Or if not, if it's like, should I go and look at the market and see if there's like better opportunities out there? Because I could potentially buy a company that's trading at a lower PE multiple with like roughly the same earnings growth. Maybe that's a better opportunity. So that's what this chart here is telling me, and it's a really useful insight because it gives us context to what we saw above. Now, similar to that, there's the forecasted annual revenue growth, and this is provided by analysts as well. And it looks like a similar sort of story, except for the market, right? So the market's only expected to have like 9.6 annual revenue growth going forward, but the company and industry are expected to have much higher revenue growth, and it's roughly the same at like 13.5 and 14.5. So no huge takeaway there, but it's a similar sort of story. Like if there was any big discrepancy, for example, I could go and look at the market, try and find a higher revenue growth opportunity, or I can go and look at the industry, see if there's a higher revenue growth opportunity. But in this case, there doesn't seem to be any like blatantly obvious sort of discrepancy or better opportunity. So that's a pretty like standard thing to see. And these are just the checks that are done for that. It's higher than the savings rate, which is the bare minimum. That's good. Doesn't beat the market in terms of earnings growth. It's not that high earnings growth, but it is still pretty strong. And then it does beat the market in terms of its revenue growth, but it doesn't exactly have the highest revenue growth, like above 20%. So it's a pretty mature business in that sense. Now, this next section here is the earnings per share growth forecast. Basically, it shows us what the company has generated in its past earnings per share and for the trailing 12 months periods, and what analysts expected for those periods in terms of the shaded blue area, like the highest estimate and the lowest estimate. And then from here onwards, this teal blue line represents the consensus, like the average from the analyst estimates going forward, and the teal shaded area is the range of analyst estimates, right? So this section is really useful, and I'll tell you how you can like use it. So as you go off and do, so like looking at this, for example, for starters, as you look at this graph, it's like, okay, I can see that the forecasts from analysts are all basically expecting growth of some sort. Some actually expect, some pessimistic analysts actually expect earnings per share to decline over the next year or so, but then basically in general, they all expect them to have improved by the end of 2024, right? Like December 31st, I can see that there. One thing to keep in mind is that these estimates provided by analysts are because they have different expectations for the company's future performance, right? So someone here, like the most optimistic analyst, might go, I'm looking at the cloud business, I'm looking at the Pixel phone hardware business, I'm looking at the AI business and their ad revenue business, and I'm thinking they're going to have heaps of earnings growth. So I have earnings per share estimates of $191 by the end of 2024 here. That analyst there is very optimistic. And then you have another analyst looking at the same company, and they may look at those same things and go, like I don't think there's going to be that much growth from their ad revenue business. Like I think it's maturing. I think their cloud business isn't going to grow their bottom line as much as everyone thinks it is. Whatever. Like they're more conservative, right? And so they think that earnings per share here are only going to be like $133. Now that's interesting, right? Because it seems like a lot of analysts covering the stock actually are more conservative, right? Like there's one very optimistic analyst out here, but it seems like there's a consensus about 150, right? Because that's the average of all of them. And so what we can do as investors is then, as we continue researching the stock and we get more information, like the company we're looking at, the industry that they're in, the overall market, like the potential for them to grow, we can then make our own forecast about what we think the company's earnings per share will be, right? So like, say I look at the stuff going on at the business, and I'm like, oh wow, like this is a huge earnings growth opportunity. Africa is going to be like a massive opportunity with a digital transformation in that market. The Shopify partnership is going to have a huge impact on their bottom line. Blah blah blah. Like I look at all those sort of things. I may go, I think that earnings per share is like 191, right? Or could be 191 by the year 2024, for example. Now, if I thought that, I may look at today's price and be like, wow, I think earnings growth is going to be much higher than 12% per year. I think it's going to be like 15, 20%, whatever the growth rate would be to get to 191. I think it's going to have really high earnings growth. Therefore, I think today's even more undervalued than some people expect. So then that would tell me that this, like based on my research and my reasoning for that conclusion that I've reached, the stock could be a really good opportunity. Now, conversely, let's say I looked at the exact same information and I was more like these pessimistic analysts, and I go, nah, like those growth opportunities don't look that good. They're kind of maturing, petering out, blah, blah, blah. Like, I don't think it's that good. Therefore, I think the earnings per share, I agree with these particular analysts. I think that the earnings per share will be roughly like 133 by the end of 2024, like if I'm not that optimistic. Then if I looked at that, I may think that the earnings growth, that would mean that the earnings growth expectations for me would be even less than 12%. So I'm like, no, I don't think it's going to have as much earnings growth as everyone thinks it is. Therefore, I think the multiple of 27 times earnings is too high, right? Like I think the stock is overvalued or fairly valued or whatever. So the idea is that you can go and do your own research and then make your own conclusions about what you think underlying earnings will be based on the underlying business's developments. And that can help give you context about whether or not today's price is a fair price or an overvalued price or an undervalued price and so on. So that's what this section is really useful for, because you can also get other analysts' insights about what the general consensus is around the stock. So that's what I typically use this section for, and it's really useful in that respect. Now, the last section of future, it just tells me what analysts expect the future return on equity to be in 3 years' time. And they expect it to be about 24%, which is a really solid performance, right? Anything above 20% is good. And compared to the industry of 13, which generates 13% return on equity, that's really good, right? Like it's a standout performer. It tells me it is expected to be able to profitably allocate shareholders' equity in 3 years' time, which is a really good thing to see as like a potential shareholder. You're like, okay, they're still going to be able to find profitable initiatives to invest in. So that's a good sign, hence why it passes that check here. Now, the next section I check out is the past performance section. And here, basically, Google smashes out of the park. Like we saw, it has an impeccable track record. And that's because it's a really solid, dominant business. And so it's had annual earnings growth of like 27% over the past 5 years. And we can see that breakdown here in this chart, right? So we can see as revenue has grown, earnings have followed suit as well. Basically, everything's trending up and to the right. A bit of a bumpy period here throughout 2018 and 2019. But for the most part, over the long term, it's important to see that it has been trending up and to the right, which is great to see. Now, one thing to keep in mind is the net profit margin here, as we can see, is now 29%, but it was actually 20% last year, right? So it's actually improved significantly in the short space of 12 months. And now why is that? It's like that's likely contributed by the fact that the operating expenses haven't increased as much as revenue has, right? So the company is generating scale. As its top line is growing faster than its operating expenses are, that means more money flows through the bottom line. So we can see here, this purple line here was flat, meaning they're spending roughly the same amount of money on research and development, sales and marketing, general and admin and stuff like that, those operating expenses. But we can see here that it's like, because of that, we can see here that because they're generating more sales and they didn't have to spend that much money on those things, the profit just goes straight up, right? That money goes straight through to the bottom line because it's not like a very variable cost business. It's a very fixed cost business in that sense. So very interesting to see and very promising to see that it's like able to improve profit margins so much in such a short amount of time. It was a really impressive year for this company over the past 12 months. So that's good to see. Now, this is very similar to the future growth section, but it's just backwards looking. Company smash out of the park in terms of annual earnings growth over the past 5 years, beat the industry significantly, and 7% difference per year makes a big difference over the long term. And compared to the 13% interest, it's just 13% growth is just even better. 97% of the past year, as we saw, it nearly doubled its earnings. Incredible year when a lot of people went to digital and started spending much more on digital ads, and obviously Google was a beneficiary of that. Compared to the industry, it's even better because they lost about 9% in their earnings over the last year, and the market overall was about 41.6%. So even smashed out of the park, even though 41% is huge. So Google, very impressive business there, and more to support the bit I said in the summary of like how the company is incredibly profitable, it's able to generate a return on equity right now of about 28.9%, and that's very high, right? Anything above 20 is good, and considering that is much higher compared to the industry, that's also another great positive sign. So it's a very dominant business with very profitable initiatives to invest in. Similar sort of story here. The company's return on assets, what amount of profit it's able to generate off its assets, and likewise for its capital employed. The company has a return on assets of about 20% versus the industry of like 8.4. Not too meaningful to me here, but still a good metric to check just to see that it, or to confirm that this company is like an asset-light business. It's not like a big infrastructure stock or whatever where it needs to invest heaps in physical assets and stuff. It's actually like quite a profitable business where it has a low asset base, so it's able to generate high returns on assets. And the return on capital employed, basically it's just good to see that this trend is improving, right? It was 16.8% 3 years ago, and now it's able to generate 25.4% in the last year. So that's really good to see that's moving in the right direction. Now, the next section I have a look at is the financial health section, and just to see that like the company's balance sheet isn't at risk, like it isn't too leveraged. And as we saw from that earnings and revenue like fundamental summary at the top, which also included a bit of debt, the company has like no debt, right? So this company, I think that's the only check that it fails. Yeah, so we'll get to that in a second. But the first thing I check out here is, does the company's short-term assets cover its short-term liabilities and its long-term liabilities? And what I mean by short-term assets is like cash and cash equivalents. And is it able to pay any liabilities that are due within 12 months? And that's stuff like rent, accounts payable, any sort of loans that are going to be due within 12 months. Can it pay them off? And in this case, yes, it can. It has plenty. It could 3 times over. So plenty to pay off its short-term liabilities. And just to be extra secure, you want to see if you have cash to be able to pay off your long-term liabilities, which is any liability due over 12 months, like from 12 months and up. And in this case, it can also surpass it, right? One common misconception is people often go, oh, why don't you compare long-term liabilities to long-term assets? It's because you can't pay long-term liabilities with long-term assets, right? These are like physical buildings you've got, and like long-term assets that aren't liquid. So if a long-term debt came due of like, oh, hey, you got to pay 20 billion now, you're not going to go and sell a $20 billion building you have to pay off that debt, right? Like it's not. That's like a worst case scenario. What you would do instead is you're like, okay, do we have cash to pay off that debt? And in this case, the company does, right? Like it's even lower than short-term liabilities. So 41 billion versus 184, plenty of coverage where it could pay any of those liabilities when they come due. So very strong, solid financial position, which is great to see. And that's also reiterated here by the debt to equity history. The company has very little utilization of debt. Very good to see. It's like able to fund its own operations internally by the earnings that it's continuing to grow and generate. It's just reinvesting in the business, and it doesn't need to source any external financing. So that's why all these checks Google does so well. It's got more cash than its total debt, and it covers its covers its debt like crazy, very, very well, because like it actually it's just got so much cash and so little debt. The only thing here is that it's like it doesn't pass this check because it's increased its debt ever so slightly from 2.6% to 5.3% over the past 5 years, but that's not really a huge concern because it's so little. So good to see. And with this here, not too much of a concern given how well the company has performed in that section. In terms of its cash and everything. And so same thing here, company doesn't pay a dividend, so it doesn't do well in the dividend section at all, but that's not necessarily a bad thing, right? Because the company has such high returns on equity and returns on capital employed, it's like me as an investor, I'd look at that and be like, yeah, please keep reinvesting, because alternatively, if they didn't keep reinvesting, they would have to distribute that cash somewhere, they'd hold on to it. And I'm like, no, you've got plenty of high return on investment opportunities internally, so please hold on to that money and keep reinvesting it, because if they were to pay out to me as a dividend or as a buyback or whatever, they may lose the dominance that they have in that space, and they clearly know that they like have plenty of opportunities to reinvest profitably. So myself as an investor, I'm like, yep, keep compounding those earnings, keep reinvesting. I'm happy to see that, and I'm happy to forego a dividend, because I would struggle myself to find reinvestment opportunities of like 23%, 28% I think it was per year. So if they can reinvest at 28% per year, go for it. Keep investing, and that's one thing to keep in mind with that section. Now, lastly, I have a look at the management section, and like I said in the summary, the management is aligned. They're experienced. They've got a lot of tenure, and they've basically got, I think, experience aligned, and they're incentivized to make the right decisions for shareholders, right? So we can see the average tenure is about 5 years here. So management doesn't have a high turnover, right? They're there and they're in their roles for many years, which is really good to see. So having a look at the CEO, Sundar has been there for the last 2 years. But if we want to learn more about him, we can actually see he's been at Google for quite a while. So he's just 2 years in the CEO role, but he's been at the company way longer. So he knows how the underlying business works, which is really good to see. As for compensation, it seems like he passes those checks as well. So for such a huge $1.93 trillion company, his compensation of about $7.4 million is pretty fair, considering companies of a similar size typically pay their CEOs about $11.4 million. So pretty fair compensation, and looks to be like his salary is about $600,000 per year, and then occasionally, as the company's earnings have been growing, he receives stock-based compensation or other sorts of bonuses, and that's when he receives these massive payouts. So that's basically good to see as an investor, because I'm like, okay, as the underlying business has improved, his compensation has improved, so it's aligned. Like, I'm happy with that. It's not the opposite where it's like business's performance has been bad, yet he's still being paid heaps. It's good to see it's aligned. And now in this section here, I just want to have a look at the management and like how much they own in the stock and how experienced they are. So if I want to learn more about them, I could read through all their profiles just to get a bit more information on who the actual people are. And here I just see their tenures in the role. Like, for example, Sundar has been at Google for way longer, but he's been in the CEO role for 2 years, so that's good to see. And I also have a look at their ownership. So I want to see high levels of alignment with shareholders, and that comes in the form of high levels of stock ownership. So we can see here they've got hundreds of millions, hundreds of billions, billions, millions, millions, millions of dollars invested alongside shareholders in the stock. So that's good, because it tells me that they're aligned with shareholders. If they make a decision that is detrimental to shareholders, it's detrimental to themselves, right? Because they are shareholders themselves. So they're incentivized and aligned with shareholders to make value accretive decisions for shareholders, because they themselves are shareholders. So that's good to see. Average tenure, like I saw, 5 years, and they're very experienced, because that's a good amount of time to be at a company. And same thing with the board members. We want to look at that as well. How long have they been in the role? And their tenure is typically good, like definitely a couple of years each. And it'd be good to see, like, just read more about these people to see how long they've actually been at the company, and also just to see how aligned they are. So like we saw before, hundreds of millions, hundreds of billions, billions, millions, 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 okay, couple 100,000, almost a million, millions of dollars. So this tells me again, they're aligned with shareholders, and that's good to see, right? 16.2 years is the average tenure, and this typically tells me these people have been on the board for a very long time, and still that's good to see though, because the stock has been performing so well. I'm like, okay, you guys have got experience and the stock has been performing well, so I'm glad that person is still there, like, making decisions, because they've clearly been making good decisions for the past 17 or 23 odd years, which is good to see. Now, the very last section is just about ownership, like if there's been any buying or selling. And for this particular stock, there's no real big takeaway. I just typically look for if there's big trends of lots of insiders selling large amounts of stock. That would be a big bearish signal for me, and I'd be like, oh, why is so many people selling large amounts of stock? I'd try and look into that and see if there's any underlying reason that the company performance might be poor in the future. And alternatively, on the positive side, I'd keep an eye out for if there's any large trend of like large amounts of insiders buying large amounts of stock, because that would tell me, oh, okay, wow, there's a whole bunch of them who are now like loading up on shares. Why are they all so bullish over the last 12 months all of a sudden? So that would give me reason to look into, like, oh, is there any catalyst that's coming up that like these people are super optimistic on? But as we can see here, there's no real big takeaway, because there's been like one small trade of about $48,000 9 to 12 months ago. So nothing huge to learn there. Ownership breakdown, again, no huge takeaway. Institutions own about 2/3 of the stock. Huge companies, so there'd be lots of like the Vanguard fund and Vanguard group and stuff that would own a lot of shares. General public owns around 20%, and individual insiders, the likes of the founders, own about 12.5%. So that's good to see. And there's been no dilution over the past year. Also really good to see. Basically, they haven't had to increase the amount of slices of the pie to like help fund their operations. The company has been able to fund its operations internally because it's such a cash generative business and it's really profitable. They haven't needed to fund themselves from external sources like debt or equity. They've been able to do it internally. So that just shows that they can sit on their own two legs, and that's really good to see, because as a shareholder, you haven't been diluted. Now, the last thing I look for here is just in the top shareholders. I just want to see if there's any big change in their holding. But in this particular case, it seems like there isn't, right? So we can see who the biggest shareholders are and how much they own. and the value of it and everything. But what I want to keep an eye out for is the change of their portfolio, change of their holding, sorry. So if there's any large percentage change, like 5 or 10% from many different people, be it positive or negative, it's a similar thing to the insider trading, insider transactions I was looking at above, where it's like, is there any key takeaway of like, oh God, like there's a whole bunch of big top shareholders who are unloading on their position. Why are they unloading? Or conversely, there's a whole bunch of insiders who are loading up on their position. They've increased by 5 or 10%, which when you're dealing with billions of dollars is quite a lot. So I'm like, why have they started loading up on their positions? So that would be a catalyst to look into something. In this case, there doesn't seem to be any huge trend or takeaway. Like these guys have increased by 35%, but there's no overarching trend across multiple sort of insiders, multiple sort of shareholders. So that's totally fine. So that's pretty much the whole review of Google and like how I got those insights that I mentioned at the start. Like the company's got an impeccable balance sheet, like an impeccable track record, pretty good future prospects in terms of like its earnings growth, and it could be potentially good value if you like agree with those particular numbers that are inputted in the model. So as for next steps, what I'm going to do is I'm going to add this to my watch list so that I can actually receive updates from Simply Wall Street and like see all the different sort of important updates like earnings reports, insider transactions, executive departures and stuff like that. But also what I'm going to go do is I'm going to go have a look at those competitors. I'm going to have a look at Facebook and Meta platforms and see how it performs. And I'm also going to have a look through that share price performance chart I showed you and look at all the key developments to try and get a more qualitative understanding of the business and understand what's happening or what developments are going on, and basically just have a look at, once I've developed that, then try and have a look at what I think the earnings might be in the future, right? So then once I've done all that research for the past performance and like what's been going on, and then I try and make some expectations and forecasts for the future, that can then help me try and decipher if today's value or today's price is like a fair price to pay or if it's undervalued or overvalued, because I then have some expectations of my own that are founded on research as to what I think the company's future prospects look like. So that would be my next step. So I hope that's been helpful because if you're looking into Google as well, I'm sure that could be helpful. So if you have any questions, please let us know in the comments below. And other than that, thank you so much for watching.